Gold, an asset as old as time, and still the ultimate safe haven in today's chaotic markets. But what happens when politics and macroeconomics collide? Now that Donald Trump has won the 2024 presidential election, the policies we've seen before, tariffs, protectionism, and a focus on America first, are all back in play. You might think, oh, I know how this story is going to end. But what if I told you that the real story is just beginning? In our last video, we broke down how tariffs could drive inflation higher and why the Fed Reserve might keep rates elevated in response to that. But today, we'll be zeroing in on something even bigger: gold. If you're a trader, investor, or someone just trying to make sense of these turbulent times, this is the video for you. Let's start with some big questions. Why did gold hit an all-time high of 27.90 earlier in the year? Why did it tumble right after Trump's election win? And most importantly, what happens next? Is gold gearing up for another massive rally? Or are we looking at a pullback as optimism floods the markets potentially? Let me show you something. Look at the spike in gold before the election. This spike wasn't just some random market noise. It was a reflection of geopolitical tensions, inflationary fears, and a cautious Fed Reserve. Wars in Ukraine and the Middle East have rattled global markets, sending energy prices and inflation soaring. Meanwhile, the Fed Reserve has been talking and cutting rates, weakening the dollar and boosting gold's appeal. But now, with Trump's victory, it's changing the game. His track record of protectionist policies could reintroduce a new set of challenges: tariffs that could disrupt trade, inflation driven by rising costs, and markets that are anything but predictable. Here's the twist: gold isn't just about uncertainty anymore. It's a lens through which we can understand the next moves of the economy, the markets, and possibly even the Fed Reserve itself. So, what does this all mean for traders like you? Stick around because we're diving deep into the strategies that could help you navigate this shifting landscape, whether you're a golden bull or a golden bear. Let's get into it. To understand what could happen next, let's first look into why gold reached that 27.90 high earlier this year. There was a lot at play here. First, the impact of ongoing geopolitical tensions. Conflicts like the Russia Ukraine war and the Israel Iran hostilities don't just disrupt global stability, they also shake up energy markets and supply chains. When fuel and commodity prices spike, inflation follows. Now, pair that with a dovish Fed Reserve policy. Throughout 2024, the Fed Reserve had been cutting rates or talking about cutting rates to address slowing growth and to cushion the economy, which puts downward pressure on the dollar and real yields. That makes non-yielding assets like gold especially attractive. Here's a chart that shows the upward momentum gold had built up in 2024. You'll notice that each time a geopolitical risk came into the picture, gold saw a bump upwards. It's a classic case of investors seeking safe havens when global risk rises. And it wasn't just global tensions and inflation that fueled this rise. Uncertainty around the presidential election had its role too. Investors were bracing for the unknown, especially given Trump's past protectionist policies that historically disrupted the markets. All of these elements created a strong bullish sentiment on gold. Now, let's unpack how these geopolitical risks are influencing markets more broadly. The escalation in the Russia Ukraine war has a direct impact on commodities, especially energy and the grain markets. Europe, which remains heavily reliant on natural gas imports, faces potential price surges if energy supplies from Russia tightens further. This would amplify inflationary pressures in an already strained economy. And the latest nuclear doctrine changes from Russia? That's a bold move, signaling the stakes of this conflict. It's not just posturing. Markets react to these developments. Gold, as a hedge against uncertainty, rallied when nuclear threats escalate because the financial system becomes highly risk adverse. Meanwhile, in the Middle East, the tensions between Israel and Iran continue to simmer, threatening stability in a region critical to global oil supply. Any disruption here could lead to price spikes across the energy markets, further fueling inflation and increasing the appeal of gold as a safe haven asset. Here's a chart showing the historical correlation between geopolitical crisis and gold price spikes. You notice how gold often reacts to these shocks, becoming a key asset during global uncertainty. Now, with these global tensions laying the groundwork for gold's rise, Trump's victory has added another layer to the story. But the market's reaction might not be what you expect. Let's explore why gold took a dive following the election. Let's think about it. With Trump back in office, there's renewed optimism that his policies will boost domestic growth. Investors anticipate that his pro business agenda will strengthen the economy, so they're more willing to move towards stocks and other high yield assets. This optimism strengthens the dollar, making gold more expensive for international buyers, which naturally pressures price down. Here's a look at the decline post election. This reaction reflects that shift to a risk on environment, as investors initially see Trump's return as a boost to the US growth. Now, let's consider what might happen if Trump reintroduces tariffs. This is where things will get really interesting. We saw a similar scenario back in 2018 when Trump's tariffs on Chinese imports and metals caused a cost push inflation, driving up prices on imported goods. And what happened? As price rose, so did gold. Investors turned to gold as a hedge against the rising cost of goods and economic uncertainty. Here's a look back in 2018. Notice how gold prices climbed as tariff policies came into effect. Investors anticipated inflationary pressures, which made gold a natural choice as a hedge. So, if Trump brings back tariffs, we could see inflation pick up again. Cost push inflation could become a significant factor, especially if supply chain issues persist. And if the Fed holds off on cutting rates further due to persistent inflation, we're looking at conditions that could again fuel another rally in gold prices. Now, if you're trading gold, here are a few scenarios to consider. I'll go over different strategies for each possible outcome from the expected tariff implementation to no tariffs at all, and finally, a steady Fed Reserve keeping rates on hold. Let's look at scenario 1, where tariffs are introduced and inflation follows. In this scenario, assume that Trump reintroduces tariffs, driving up prices on imported goods, which could increase inflationary pressure, similar to what we saw in 2018. Cost push inflation would likely be back in play, meaning that the cost of goods rises due to increased import expenses, and supply chain may experience further strain. In a tariff induced inflation scenario, gold typically strengthens as investors hedge against rising inflation and economic uncertainty. Here's a multi layered approach for traders. Watch for the technical retracement zones, such as the 50% or the 61.8 Fibonacci levels, where gold prices might pull back before resuming an upward trend. Major moving averages like the 50-day or 200-day moving average are strong indicators of support levels in an uptrend. For example, if gold corrects to these levels during periods of uncertainty or dollar strength, it may present good buying opportunities. Remember to monitor inflation linked indicators. Traders could keep an eye on the CPI reports and the PCE inflation data, which may signal how intense inflationary impact of tariffs is expected to be. If inflation data exceeds market expectations, expect potential bullish activity in gold. Here, we're looking at where buying opportunities may align with key support levels in a potential tariff driven inflation scenario. Now, in scenario 2, where we look at no tariffs but the dollar remains strong. If no tariffs are introduced, the dollar may remain strengthened as economic optimism under Trump's presidency continues to boost the US growth expectations. In this case, the inflationary impact might be more subdued, and safe haven demand for gold may decline as a result. Here's how traders might approach gold in a risk on environment without the added inflationary pressures of tariffs. In a strong dollar scenario, consider shorting gold in the short term. Look for resistance levels on the charts, such as the recent high at 2790 or significant pivot points, as potential entry levels for a short trade. Options like the bear call spreads could be effective here as well, allowing you to gain from a potential gold price decline while managing risk. This strategy could capitalize on a downward movement potentially without the full exposure of a short position. Now, again, remember to look out for some key indicators such as the US dollar index, the DXY, or Treasury yields can also provide hints on dollar strength. If the DXY continues rising alongside yields, it might confirm that strong dollar trend, pressuring gold to the downside. Here on this chart, we're looking at some potential short opportunities or positions for shorts on gold, focusing on the resistance areas to look out for in a strong dollar environment. Now, for the third scenario, if the Fed Reserve holds rates steady amid persistent inflation, in this scenario, the Fed Reserve may pause on its rate cuts to prevent further inflationary pressures from building. Holding rates steady despite economic headwinds could create a mixed environment for gold, pressuring it in the short term but also supporting it in the long term as inflation concerns remains elevated. A steady rate environment with inflation concerns is a situation for gold. Here's a trading approach that might work well. Buying the dips. This strategy focuses on accumulating gold positions on temporary price dips, which might occur in response to fluctuations on the dollar. The expectations here is that over time, inflation will support gold prices. Look for price dips to significant support levels, especially the round number levels, the psychological support levels. You could consider using a partial entry strategy where you scale into positions over time, buying small portions at each dip rather than a single large entry. This spreads risk and capitalizes on long term inflation expectations, especially if inflation continues to erode real yields. But then again, always remember to keep an eye on real yields, nominal yields adjusted for inflation, and Treasury inflation protected securities. If real yields trend lower due to inflation without rate hikes, gold could rally in response. This can signal the potential for a stronger gold rebound, even with steady nominal rates. So, what's the big picture here? In times of geopolitical tension, inflation spikes, or market uncertainty, gold often plays the role of a hero asset. We've seen this movie before, with Trump, tariffs, and inflationary waves. And there's every reason to believe the next chapter could follow a similar script. Whether you're bullish or bearish, what matters most is having a strategy in place. Will gold shine under renewed tariffs? Or will a strong dollar keep it in check? Now that's for the market to decide. But you'll be ready. If this breakdown has helped you, smash that like button and subscribe for more insights into how politics, policy, and macroeconomics shape trading opportunities. Drop your thoughts in the comments. Are you buying the dips, shorting the highs, or sitting on the sidelines? Let's keep the conversation going. Until next time, stay sharp and trade smart.